$315 trillion. That is the amount of debt the world is carrying based on recent estimates. It is so massive that if you stacked $100 bills on top of each other, that tower would reach the moon, come back to Earth, and do it again dozens of times. But here's the disturbing part. Debt is not really about money. It is about control. Every mortgage, every credit card swipe, every student loan, every car payment is a contract against your future. And the people who truly understand this system do not just make money from debt, they use debt to shape nations, control behavior, and quietly rule the modern world. In the next 20 minutes, you'll see how debt evolved. From ancient clay tablets to European banking families, to government bonds, to Wall Street, to credit cards, to student loans, and finally to the credit score controlling modern American life. By the end of this video, you may never look at borrowing money the same way again. I'm Easy Finance, and today we're exposing the hidden system behind one of the most powerful financial weapons ever created: debt. At its core, debt is simple. Debt is a promise. You borrow money today, you promise to pay it back tomorrow. But the trick is hidden inside that word, tomorrow. Because when you borrow money, you are not only spending dollars, you are spending future hours of your life. When you swipe a credit card for a $7 coffee, when you finance a car, when you sign a 30-year mortgage, you are making a deal with the future version of yourself. You are saying, I will work later for what I want now. And this is where debt becomes dangerous, because debt does not just charge you money. Debt charges you time. Let's say someone borrows $500 through a high-interest payday loan. At first, $500 does not sound terrifying. But imagine that loan charges 5% every week. After 1 week, the balance becomes $525. After 2 weeks, it is not $550. It is $551.25, because now the interest is creating more interest. That is compound interest. People say time is your friend, but in debt, time becomes the weapon. A small loan can turn into a monster. A short-term decision can become a long-term chain. And once you understand this, you realize something important. Banks do not simply sell money. They sell time, your income, your future. Debt is not new. Thousands of years ago, ancient civilizations were already recording debt on clay tablets. In Mesopotamia, people borrowed grain, silver, livestock, and land. But here's what makes ancient societies fascinating. They feared debt. They understood something many modern economies try to ignore. If ordinary people become buried under too much debt, the entire social system can collapse. In ancient Babylon, rulers sometimes declared debt forgiveness, a debt jubilee, a reset. Certain debts were canceled. Families were freed. Land could be returned. Why? Because ancient rulers understood that debt was not just a financial issue. It was a social stability issue. Too much debt could turn citizens into servants. Too much debt could destroy families. Too much debt could create rebellion. Back then, rulers sometimes canceled debt to protect society. But over time, the powerful learned a different lesson. Do not cancel the debt. Control the debt. Do not break the chain. Make the chain invisible. And eventually, the clay tablet became a contract. The contract became a bank account. The bank account became a credit report. And the credit report became one of the most important numbers in your life. For a long time, many societies viewed lending money at interest as morally dangerous. In medieval Europe, the Catholic Church condemned usury. Charging interest was seen as profiting from another person's desperation. The idea was simple. If someone is struggling and you use their struggle to extract more money from them, something is wrong. But money always finds a loophole, so lenders became creative. They stopped calling it interest. They called it a fee, a risk fee, a service fee, a processing fee, a convenience fee. Different language, same game. Then came the Renaissance. Banking families like the Medici rose to power in Florence. They did not need massive armies. They did not need huge kingdoms. They did not need to conquer land. They only needed to lend money to the people who ruled land. Kings needed money. Popes needed money. Merchants needed money. Armies needed money. And when you control the money that powerful people depend on, you become more powerful than power itself. This was the moment debt evolved. It stopped being only a private agreement between two people. It became a political weapon. Because whoever controls the debt can influence the person who owes it. And if kings can owe money, then kingdoms can be controlled. By the 17th century, debt moved to an even higher level. Governments entered the game. The Dutch, fighting for independence from Spain, helped pioneer a powerful financial innovation: government bonds. A bond is simple. You lend money to the state. The state promises to pay you back with interest. But the real breakthrough was this: those bonds could be bought and sold. Suddenly, government debt became a financial product. War no longer depended only on how much gold the king had in a vault. War could be funded by borrowing from the future. The British saw this model and adopted it. In 1694, the Bank of England was founded. This was a turning point. National debt became institutional. Governments no longer had to stop spending when they ran out of money. They could borrow, refinance, borrow again, and push repayment into the future. This changed history. Empires could fight longer wars, build bigger navies, expand further, colonize more territory, and every expansion created a new reason to borrow even more. A perfect circle was born. The more empires fought, the more they borrowed. The more they borrowed, the more powerful the lenders became. And the more powerful the lenders became, the more they could shape the future of nations. This is the dark genius of national debt. The government borrows, the public pays, the creditor collects, and the machine keeps turning. At first, debt was mostly a game for kings, governments, and bankers. But eventually, ordinary people were pulled into the machine. And nowhere did this become more powerful than in America. In America, debt does not look like a prison. It looks like a house in the suburbs, a new car in the driveway, a college degree on the wall, a credit card in your wallet. That is what makes it so dangerous. By the 20th century, debt became a mass market product. People borrowed to buy homes, cars, furniture, appliances, education, vacations, medical care, and eventually almost everything. Then in 1950, the Diners Club card appeared. The modern credit card was born. This was not just a financial innovation, it was a psychological revolution. Because the credit card separated the pleasure of buying from the pain of paying. When you pay with cash, you feel the loss immediately. When you swipe a card, the pain is delayed. And that delay changed consumer behavior forever. Buy now, pay later. Live today, let the future deal with the bill. This became the emotional foundation of modern consumer debt. And then came the mortgage. For many Americans, the 30-year mortgage became the symbol of success. Before, you saved money and then bought a house. Now, you borrowed first and hoped the future would pay for it. Then came car loans, student loans, personal loans, credit cards, buy now, pay later. That became normal, sometimes even glamorous. But here's the part most people miss. Debt is one of the best business models ever created. A company sells you a product once, but a lender can collect from you every month, for years, sometimes for decades. A mortgage can last 30 years. Student loans can follow people into middle age. Credit card debt can grow faster than many people can repay it. Debt does not need a factory. It does not need inventory. It does not need raw materials. It only needs your future income. And then came one of the most powerful inventions in modern finance, the credit score. Most people think a credit score measures how rich you are. It is not. A credit score measures how reliably you participate in the debt system. If you have no debt history, the system may treat you like a ghost. No mortgage, no car loan, no apartment approval, no easy access. In modern America, the credit score became a financial passport, and the price of that passport is participation in debt. Then Wall Street took debt to another level. Debt was no longer just something you owed. It became something investors could buy, sell, package, slice, trade, and speculate on. Mortgages, car loans, credit card balances, corporate bonds, student loans. All of it could be transformed into financial products. This process is called financialization. It sounds sophisticated, but in simple terms, it means turning debt into the raw material of the economy. Banks issued loans, then they sold those loans. Then investors bought the rights to collect payments. Then those payments were packaged into securities. Then those securities were sold again. Fees were collected at every step. Risk was moved around. Profits were extracted. And the entire system became more complex than most people could understand. On the surface, it looked like innovation. Underneath, it was a tower built on promises. And in 2008, that tower collapsed. Millions of Americans could no longer pay their mortgages. But Wall Street had built an entire global machine on top of those payments. When the housing bubble burst, the damage spread through the financial system. Families lost homes. Workers lost jobs. Retirement accounts collapsed. Small businesses suffered. But many of the institutions that helped create the crisis were rescued. The message was clear. When ordinary people fail, they are punished. When the financial system fails, it is protected. After 2008, debt did not disappear. It grew. Interest rates were pushed down. Cheap money flooded the system. Governments borrowed more. Corporations borrowed more. Households borrowed more. The machine did not stop. It became bigger. And today, global debt has climbed past $300 trillion. That is more than 3 times the annual economic output of the planet. The modern world is not just using debt, it is addicted to debt. And now, debt may be entering its next phase: digital money, algorithmic lending, automated credit decisions, programmable finance. In the past, debt was written on clay tablets, then paper contracts, then bank databases. Now, that may become fully digital, trackable, and adjustable in real time. Loans could be approved or denied by algorithms. Interest rates could be personalized. Credit access could depend on your behavior, your data, your spending patterns, your history, and your score. The chain may no longer be made of metal. It may be made of code. And that is what makes the next version of debt so powerful. It may become faster, smarter, more invisible, and harder to escape. But debt itself is not always evil. Debt can build homes, start businesses, fund education, create opportunity. The problem begins when an entire economy depends on people never escaping it. Because then, debt stops being a tool. It becomes a system. And when the system profits from your dependence, freedom becomes expensive. Debt began as a promise. Then it became a tool. Then it became a weapon. And today, it has become one of the foundations of the global economy. Governments need it. Banks profit from it. Corporations depend on it. And ordinary people are trained to live inside it. You do not have to hate debt, but you do have to understand it. Because the rich use debt to buy assets. The poor use debt to survive. Same tool, completely different outcome. And if you do not understand the game will quietly own your future. I'm Easy Finance. Subscribe for more videos that reveal how money, power, and the financial system really work.